Warren Buffett. Warren Buffett is the main subject of today's video. He made a move that was honestly pretty shocking to me. And I want to explain why that's such a shocking thing and what's exactly going on here, in my opinion, in regards to Warren Buffett's pretty shocking move there, okay? Then we got a bunch of little teeny videos to react to in this one here today. First one up here, Oppenheimer downgrades Nike. Little 1-minute clip. I just started buying Nike stock, so yeah, looking forward to hearing that one. Starbucks, a little 3-minute clip here. Starbucks unveils a new store design. Starbucks actually looks like a pretty good value in regards to the stock price for the first time in many, many years. And so looking forward to kind of seeing what they have there. Then we got this little 2-minute clip to react to. Producer prices rise more than expected in January. Uh-oh. Then we got this little 1-minute clip to react to. Consumer sentiment coming in as far as those numbers, highest since July 2021. And last one up here, market pullback or opportunities to jump into the Magnificent Seven. I appreciate y'all being here as always. Thanks so much. Thank you for being subscribed. All I ask in return is that you smash that like button. Smash that like button. Make sure you're subscribed if you enjoy these videos. And other than that, if you're looking to join my group of super investors, pin comment down there to apply to join my private stock group, get access to all my course curriculums, my private Discord chat, all those sorts of things, okay? So, Warren Buffett, he went ahead and sold some Apple. Now, some people were like, oh, it's not that big of a deal. It was only, 1% of his position or so, okay? That's a way of looking at it. Sure. It's not like it's some massive sell, like, oh, he sold 10% or 20% or 30% or something like that, right? Or all the shares. But, and this is very important, it is a sell. Why is Warren Buffett selling any Apple shares? You got to ask yourself this. I think it's very important. You can't just be like, oh, it's only 1%. It doesn't matter. No, there's something here, okay? Because listen, I've been a Buffett follower literally since I got in the market, 08, 09. Like that was how I started learning about the stock market, and I'd watch old YouTube videos of him that people would somehow upload back in 08, 09, even 2010, and just eat up everything I ever could in regards to Warren Buffett and, any old speeches he would do at colleges and things like that, right? So here's why this is a big deal. Warren Buffett only sells a stock usually because he wants to start moving out of that position, or it's a situation where, let's say it's a bank and the position's gotten too big from a regulatory standpoint, maybe he owns too many of the shares, that it becomes like a controlling interest in when you're in the banking space, there's a bunch of complications that happen there, okay? So, which one is it? It's obviously not the banking situation. It's clearly him wanting to cash out some shares. But why, right? Does he think Apple's overvalued, fairly valued? I don't know. He doesn't need to raise cash. That's the thing. You might say, well, a normal investor, a mom and pop investor, if they sell, some shares, it's because they want to raise money. He doesn't need money. Buffett's loaded with cash. Berkshire Hathaway's loaded with cash to the sky. They don't need any more cash around. I can tell you that much. They got cash to the sky. They might be They might be the most cash loaded of any company in the world right now. Thinking about it, so they don't need cash. I can tell you, they got way too much cash, if anything. So the only reason I can think he would sell some shares, and keep in mind he could be selling more shares here in the future, is if he thinks something's fundamentally wrong with the business model, or he thinks the company might be a little overvalued. And it's one of those two situations, folks. And so I thought that was very surprising. And, we'll see in the next quarter. Maybe he sells more shares. I don't know. We'll have to see. But I thought that was, you can't just gloss over the fact, because Warren Buffett does not operate like a hedge fund. Hedge funds are in and out of positions all the time. Warren Buffett's not that. He's only selling because he's fundamentally, something's wrong, it's overvalued, or, it's for a regulatory reason. So that's the Apple situation. Pretty shocking to see him sell even one share, never mind, percent of the position. Oppenheimer downgrades Nike. Okay.
Oppenheimer's desk grabbing our attention this morning, downgrading Nike to perform, saying that they're concerned that top-line numbers at the company are likely to remain sluggish over the next couple quarters. Analysts there led by Brian Nagel, adding that the benefits from the company's $2 billion cost savings plan will take time to materialize. CEO John Donahoe did announce the layoffs in a memo to staff last night, which we were able to obtain here at CNBC. So he notes that there's going to be a 2% overall reduction to the workforce. So that's of 80,000 people, about 1,600 employees. Donahoe saying the company is, quote, not currently performing at our best and holds himself and leadership responsible. I think the story here, Mike, though, as I mentioned earlier, it's not just about cost cuts for Nike. It's taking a step back, looking at the business. And here's a direct quote from the internal memo, redeploying our resources to increase investment in our most significant fields of play and growth opportunities. And he lists them: running, women's, and the Jordan brand. This is how we will reignite our growth. So lays out very clearly the strategy here in terms of taking those savings to reinvest in those three strategic areas where you could argue Nike hasn't been growing as fast as it would like to. Yeah.
Okay, so you guys know, before we get into Starbucks and these other guys, you guys know I've started a position in Nike, and I plan to build that position out over the next several months, right? So first off here, what do I think about him attacking running, he mentioned, women's, and Jordan brand, okay? So, Jordan brand's an obvious, right? The brand's so, I'm wearing a pair of Jordan, sweats right now, okay? That's obvious. Running, listen. They have faced a lot of intense competition in the running space over the past few years, okay? Hoka, On, some of these other brands have come out of really almost nowhere. And, you know, you go into a Foot Locker now and you go right to the front window and you're going to see those sorts of brands. They're serious competitive threats in the running space to a company like Nike. And so Nike's really got to double down on running. I think it's a very smart idea. We got the Olympics this year, and they got to make sure they're going to continue to get people that are getting into running, right? Because once you capture somebody, they never really switch. I never switched from Nike. I'm a runner, a sprinter, obviously, in college, and I still run to this day, and I wear nothing but Nike. I try some other brands here and there, but at the end of the day, I always come back to Nike. I'm just used to it. I just trust it. And, you could tell me there's something better out there, no different than you could tell an Apple user, Android's better or whatever, and it just goes in one ear and out the other. We're just over there, right? And so I think they got to focus on that. Women's, guess what? They have faced a lot of competition in women's from Lululemon specific, right? And so they've got to make sure they're capturing women. Women are just, it's 50% of the population. You're talking about, obviously, women are interested in these sorts of products, and that's why Lululemon numbers so doing so great. And so 100% focus on women's, focus on running. Running's what built Nike. It's what built Nike. Jordan took it to the next level, right? And so, smart. Good moves overall. I like that. And in regards to the growth rates that Oppenheimer brings up, no one's expecting great growth rates from Nike over the next couple quarters. We all know that. That's old news. But what we are expecting is back half of the year, a nice, sweet pickup in profitability, and then a much bigger ramp up in profitability in 2025. Starbucks unveils new store design. Let me know what you guys think about this new store design here.
Company introducing today its new inclusive stores framework, opening a first location in Washington, D.C. with some key upgrades, including a new point of sale system.
Inclusive store design, that sounds woke.
Assist and screen magnification, and support for language diversity.
Do I like
Customer
that?
order boards will have
do I like this? Oh, man. It kind of feels like high-end cafeteria. No? Maybe it'll have to grow on me. But it kind of feels like a high-end cafeteria.
Assist and screen magnification and support for language diversity. Customer order boards will give visual...
It looks like something you go up and order at a nice university. And you go to order your food at a nice university, like a baller university.
Dates, new acoustics and lighting features, and power operator doors that are easier to activate from different heights and angles are also included. All newly built and renovated Starbucks stores in the U.S. will incorporate this framework in some capacity in the future as the company looks to grow its U.S. footprint by 4% this year from 16,000 locations, including licensed stores. North America's President Sarah Trilling tells CNBC the expected ROI is meaningful.
I think about it as something that's going to, help us, right, in terms of customer connection. It's going to help us in terms of employee engagement, partner engagement. And so, if anything, we're optimistic, that we're going to get a great return on it as well.
Now, I asked Trilling, does this mean you're moving away from formats like...
Nah, what Starbucks knows? They're like, dude, they know something, okay? You know what they know? They know there's a lot of baby boomers that are aging, and, it might be a lot more people in wheelchairs in 10 years, 20 years, 30 years from now. So they're like, oh, man, we got to make sure we're wheelchair accessible here.
Through which have been hugely successful. She says not at all. And in fact, some of these upgrades, like better sound control, will actually help baristas working drive-thrus, as it's apparently awfully loud in there. Worth noting, store conditions were also a sticking point for some of the workers who have organized at Starbucks over the last few years. Sweetgreen and McDonald's are just some other names who have tested out different store formats, including some automated Sweetgreen locations and, of course, the new Cosmix location that McDonald's has, focusing on snacks and drinks. So you're looking at companies trying to really figure out what consumers want, make things better for workers, and also make some money at the same time, guys. Back over to you.
No, I mean, look, store refreshes at these restaurants have been drivers of sales. I was going to ask you about the bathroom policy, because that is a big thing, right, for Starbucks, where they do have an open-door bathroom policy. Most of the Starbucks in New York, I see, and I know it can be an issue for the employees and for customers.
And you may remember that they did make some changes. I believe it was under Howard Schultz, who is obviously no longer CEO, because baristas did express some concern about that, Sarah, and the safety in some of the stores. That's also been a priority for Starbucks as they kind of look to reinvent and make things better for both customers and the baristas. I know you guys were talking about the stock price and what could kind of drive that. I just did want to mention, too, the company's looking to cut about $3 billion in cost over the next few years. $1 billion worth of that savings, they say, is going to come from making these stores more efficient. So when you see changes like that, this is all part of the bigger plan there.
Why has it been such an underperformer?
It's hard to say. There have been so many different factors to the Starbucks story. Even if you look at this last quarter, they did have some headwinds in the Middle East, Sarah, but there was also a protest that went on in its U.S. market as a result of that. And what the company says was due to misperceptions around its stance on the conflict in the Middle East. So there's been so many different things. Last year, it also had a big impact, as we were talking yesterday, about the Chinese market, because they do have such a presence there and such, a force in that market. So there's been so many different things. This union fight has been ongoing. They are now 3 CEOs into this over the last few years. So this is part of the triple shot reinvention plan, and we will see how it plays out and how investors react.
I mean, the problem is the more you want to stick your head in all these things, right, the more likely you are to potentially put yourself in a situation where, people are mad at you. On either side, right? And they're doing boycotts and this and that, and it's just like, man, sell your flipping flapjack and coffee, and let your employees choose whatever they want to choose and who they want to vote for, and the policies they think is important and things like that. But you as a company, when you start choosing that, man, you just open yourself up to one thing after another, and then you don't comment on another issue, then everybody's after you for that. Why didn't you comment on this? It's just like, dude, it's a downward spiral. I would think these folks would have known this by now, but I guess not. Producer prices rise more than expected in January.
Economists, since that 8:30 upside PPI, surprised to see how they changed their forecast for the Fed's preferred inflation gauge. The PCE comes out on February 29th. On average, the survey of 7 forecasters sees them boosting their outlook for core PCE by 1/10 to 0.4%. Doesn't sound like much, but it is more than double the December rate. And then what you see, here's a bunch of the estimates we have here. You can see up pretty much 0.1 across the board. Pantheon, Citi, Morgan Stanley, JP Morgan, same with Goldman Sachs and some of those you don't see here. The annualized 3-month rate, if these forecasts end up being right, would rise by a percentage point to 2.4, half a point for the 6-month. It would actually decline for the year-over-year rate because a bit bigger or a hotter January 23 number drops out. Anyway, it's going to give the Fed pause is the bottom line. And I want to show you a new chart we've never shown before. Sarah, what this does is it tells you the number of 25 basis point cuts now in the January 2025 contract. I don't know if that helps viewers envision where the market is, but you can see they were up as many as 7 cuts built in the middle of January. Now they're down to playing with 3 3/4, 25 basis point cuts there. Sarah?
Yeah, so they've come to the Fed. They've come to the dot plot, the market. basically.
Exactly. There's just a little bit of a gap between of 3/4 of 1/4 point, essentially.
What do you make of the argument that the economy is potentially overheating again? I mean, I know it's preliminary, strong word. We don't want to say it too much, but just some of these data points adding up with a stronger economy after the January payrolls number.
Yeah. I'm seeing a lot of commentary, Sarah, about this idea that there's these one-time increases that happen in January that are not seasonally adjusted. Things like outpatient hospital services, a bunch of things that were in there. I am wary of the idea that it could be overheating. I think you need to take it into account, but I wouldn't necessarily prejudge it. If this is really a one-time January effect, it should work its way out by February, perhaps by March. And so you could still be on pace for a summertime rate cut. Maybe it's fall now, but you could still be on pace if you get March, April, and May.
Fall?
Come back into the line after some of these one-time price increases.
Yeah, January's funky. I mean, even you could say the same thing with the retail sales, and we wonder if the consumer's slowing more than expected because of weather and holiday and all that stuff.
Right. You don't want to go too far into the weeds, but when you're fishing, Sarah, sometimes that's where the fish are, in the weeds. So you got to go in there. And we know that there's stuff in there, like, for example, the BLS said it today, they don't adjust for outpatient health services, but Reedy and Shepherdson, he says there's a seasonality to it. So don't want to get too detailed on this thing. It's one you take under advisement. Don't panic. Watch it. If it keeps going, well, then you got to be worried.
Yeah, so if you want to know a little bit about inflation here, here's what I heard on the Texas Roadhouse conference call last night. I listened to that conference call, okay? And what I heard from Texas Roadhouse is they're going to do, I believe it was a 2.2% menu hike in price. They're also talking about, they're expecting labor to be up 4 to 5 percentage points, right? So that's a pretty big number, 4 to 5 percentage points, and they're still having issues with beef pricing. And so, and I know that beef pricing issue because I tried to go to Whole Foods. I wanted to get some filet mignons one night. $35 a pound. I'm like, oh, you got to be flipping my flapjacks for a filet? Come on, man. All right, next one up here. Consumer sentiment at 79.6 in February.
Preliminary February readings for University of Michigan, which means in about a week and a half, 2 weeks, we'll get the final readings. 79.6 on headline, and even though that's less than we expected, that is still the best, the highest form of confidence going back to July of 2021. And if we look at current conditions, 81.5. Now, definitely lower than our previous, and it's lower than expectations. But 81.5 isn't bad because 81.9 in the rearview mirror was the best since July of 2021. Expectations, 78.4. This is the only one of the three that's actually above expectations and sequentially higher. 78.4 is the best since, we're going to have to go back a bit, July of 2021 once again. Now inflation, 3% on the one-year outlook. Now, that is the highest since the end of last year when it was 3.1. It has been at 2.9, and that's the lowest since 2020. So we have moved away from that just by 0.1%. Finally, 5 to 10-year inflation, 2.9 equals the rearview mirror, 110, higher than we were expecting. That now makes 1, 2, 3, 2.9s in a row. To find a lower form of inflation than 2.9, you have to go back to September of 2022. We see that yields are definitely on, but much higher than they were on the close yesterday, but coming down from the most extreme levels. Consider we're up 12 basis points on the week on 10-year right now, and on the 2-year we're up 17 basis points on the week. Sarah, back to you.
So a few things here, okay? First off, that consumer sentiment number, 79.6, I believe it was there, that's still not even a great number. Actually, we're definitely improving, and that's great, but this is still not like, wow, can you believe we're at 79? Like, that's not that sort of number. It's like, okay, things are okay, right, from consumer sentiment side. But the main thing is, the thing that killed consumer sentiment so bad, right? Well, there's two things. Consumer sentiment, the Michigan Consumer Sentiment Survey, they've been doing that since they started that in like the 1950s, 1960s, somewhere around there, okay? We had the lowest readings in history in 2022, summer of 2022. And the reason being was, I think, we dealt with Rona, and then after we finally got finished up with Rona, we went straight into a super high inflationary environment, right? And simultaneously, the market was getting wrecked at that time. So it was just like, it was a perfect storm to kind of get consumer sentiment to be the worst in history, to be honest, right? The good news now is the market's obviously rolling, right? Hitting all-time highs. So that the market is a huge confidence builder for folks out there. It really is. So you have that component. On top of that, you obviously have inflation not hurting people nearly as bad as it was a year ago or certainly 2 years ago, right? And so both those things matter substantially, and that's why you're seeing a consumer sentiment number, really start to come back to life. All right, next one up here, market pullbacks are opportunities to jump in the Mag 7.
Of the day, opportunistic. Can you tell me why
what else would you
and
jump
in what
into?
ways investors could be opportunistic today?
Yeah, good morning, Contessa. Thanks so much for having me here. I think, February, although February is sort of over, and March tend to have these days where stocks just pull back. And I think that particularly for younger investors and just, traders with longer term holding periods, there's been so much money sitting on the sidelines, trillions of dollars sitting in those 5% accounts, which are great. But now you have stocks performing in 2023. So, look what happened during COVID. Look what happened during 2022, massive bear market. So opportunistic, on these days that you get these little pullbacks, have your chance to get into the top semiconductor stocks, the quantum stocks, the S&P 500, whatever it may be, and just plan to hold it for a couple of years. The market works quite efficiently over time. And I just think that, with all the money on the sidelines, there has been FOMO and it's time to get back in, time to get off the sidelines.
Do you think that a little pullbacks are a reason to jump into the Magnificent Seven?
This is so funny to me. Time to get back in. It's like, we're nearly a year and a half into the bull run. Literally. Think about it. We bottomed the market out October of 2022. It's February of 2024. So we're nearly a year and a half into this bull run. And the fact that people are like, let's get back in. Now's the time to get back in this market. It's just like, it's crazy how long it can take for people to get confidence to jump back in the pool. My gosh.
I do, because I think that the next 5 to 10 years for the Magnificent Seven are going to be stellar. I think that AI is the engine that's going to continue moving them forward. They're good companies anyway, even without AI, if you just kind of pick them apart. Amazon had a great year. They're picking up on retail spending. They have groceries, they have pharmaceuticals, they have cloud, all of these things. And, every company, Google, they have advertising. They're good, strong, solid companies anyway. And now throw AI into the mix, and you just have this engine that's just going to power so many different technological innovations in the coming years.
You've recently added Amazon. Why?
Yeah, so for that reason, I think Amazon is a well-rounded company. They were sort of a sleeper for a little while, 2022, but I think Jassy came in and just really, shaped up the company. I think they cut costs. They became more efficient. And now they're, starting to win. They have a huge presence in the cloud business, which is expected to, double, triple in the coming years and multiply by 5 in the next decade or so. They have a strong e-commerce business. And again, they're dabbling into healthcare. They're dabbling into AI. They're dabbling into pharmaceuticals, grocery delivery, you name it. So I just think that they're kind of well-rounded and positioned. And then the ad spend is going to pick up there too. So it's an interesting play. And I think it's pulled back enough to kind of get into. It's at a decent price point.
I see that you like IBM for its quantum computing potential. Can we talk about Cruise a little bit and what you see here and what it says about your confidence in the consumer?
Yeah, for sure. So on the IBM comment, IBM is kind of, again, a company that you don't mention when you talk about AI, but they're arguably the AI leader. They've been around the longest with Watson AI. So look at IBM this year. They're going to come out of the woodworks and they're going to end up being one of the top leaders that monetizes on this. So for Cruise, and I often hear you talking about the casinos and kind of what's going on in Vegas, the consumer is spending. They're back out there. We just saw reports from China coming back online. The airline earnings were looking pretty good. The carnivals are looking great, and I think that consumers are really spending in this space. That transition from goods to services really picked up. Wages are stable. Consumers are employed, and that spending continues there. So I think it's Cruise has taken off.
Yeah, it's a little frustrating. Okay, it's a little frustrating. I can understand people wanting to just get in the market now if you haven't really been in the market in terms of like you didn't know how to invest and you're just getting involved and you're trying to figure this stuff out. Okay, I understand that. But for the people that have been in this game a long time, the fact that they've been non-existent for, a year and a half in this bull run and now they're finally ready to get in, it's just geez, Do you need a written invitation? Like, what is going on? Appreciate y'all joining me as always. Thanks so much for being here, folks. Thank you for smashing the like. Thank you for being subscribed. And once again, if you're looking to join my private group with the super investors and myself, get access to all my course curriculum, teaching you everything I got up here, then check out the pinned comment down there, and we'll see if we can get you in there maybe next week. Much love and have a great day.